Hello, in today's video we'll be taking a look at the new day trading GPS stocks ETFs daily key levels indicator, the new V 3.0 version of this indicator, which is going to be released later this week. We'll be taking a look at the SPY session for the S&P 500 ETF, the SPY. Okay, so we're on a 2-minute chart. This new version of the stocks ETFs daily key levels indicator is the V 3.0 version, so it's going to have all the features that the SPX V 3.0 version has that you may have seen on other videos recently on this channel. Okay, so we have the 2-minute chart here. So with the stocks ETFs daily key levels indicator, there's not going to be one singular time frame to use on every stock or ETF. This indicator works on almost 10,000 different symbols. It works on symbols for stocks and ETFs that are listed on U.S. exchanges, and specifically on these four U.S. exchanges: NYSE, NASDAQ, OTC, and Amex. However, for ETFs that are large cap ETFs, such as the SPY and the QQQ as an example. The SPY mirrors the SPX and has basically the same liquidity as SPX and ES futures. So in that respect, the 2-minute time frame that we use for SPX, we're going to use that 2-minute time frame for SPY, and that would be the recommended time frame for SPY or QQQ when using this indicator. However, when you're using it on other stocks or other ETFs, then you will need to look from the 1-minute time frame up to the 5-minute time frame. And the ideal time frame to utilize the daily key level strategy will vary depending on what stock or ETF that you're trading. So, for example, Nvidia, Apple, Tesla, the large mega cap tech stocks that have high liquidity should be able to work in a time frame of 1, 2, 3, or 5 minutes. However, for other stocks that don't have very much liquidity, such as microcap, small cap, mid cap, and lesser stocks that have less liquidity, you may find that you need to use either the 5-minute or a chart time frame above 5 minutes for those particular types of stocks. So again, it works on almost 10,000 symbols that are contained, all the symbols on the NYSE, NASDAQ, OTC, and Amex exchanges. So if you're using it, for example, on microcap or small cap stocks, as an example, that are going to be stocks that may have a lot lower float and a lot less liquidity, you will need to practice with the indicator to find the right time frame for the particular stock. However, as we noted earlier, for large cap ETFs such as SPY and QQQ, then you can pretty much mirror what we use for the NASDAQ NDX index indicator and the SPX index indicator, and that is the 2-minute chart time frame. Okay, so with this indicator, this is a big upgrade for this particular indicator. The previous version was the V 1.0 version. We skipped over the V 2.0 version and just went right to the V 3.0 version of this, so it would mirror all the different features that the SPX and NDX V 3.0 indicators have. So specifically, that's going to be the market scenarios, which are now part of this indicator. So every day at the 9:30 open, the indicator will classify the open into one of 6 different market scenarios, which you will see is this market scenario for this session, Wednesday, March 18, 2026, which is the FOMC interest rate decision day. The market scenario is a function of the pre-market high, the pre-market low, yesterday's daily high, which is yesterday's RTH session high, and the YDL level, which is yesterday's daily low, specifically the RTH session low. Now, we're not going to go into all the different features of this indicator in this particular video. We're going to release a longer video later this week when we do actually release this indicator for sale. That will go into all the different features and go into the user control panel, and it will explain all the different features in a lot greater detail. For today, we're just going to briefly run over the different levels and how to utilize this indicator in trading the SPY. Okay, so in today's session, we have the main key level here, which is the bull-bear key price level, which we also term as the BBKPL. So for today's session, after analyzing market volatility, market dynamics, and recent price action, the indicator is giving today's bull-bear key price level for today's session as 669.40. Now you'll see above that we have midpoint level, and we have the R1 level, and we have this QL level, and below that we have the QL below BBKPL, this midpoint below, and this S1 level below. We also have this S1, this QL above S1 on the screen, but we'll be taking a look at that in trade number 2 for today. So above the bull bear key price level with the Stocks ETFs indicator, it's a little different than the SPX indicator. Because there's 10,000 different stocks and ETFs that this works on, and because there are a lot of people that do trade microcap and small cap and penny stocks, those have a tendency on days when they're in the news that they will go up to have a lot higher levels or a lot higher range, given if they start having extreme volatility and they're starting at a price that's either under $1 or somewhere between $1 and $10. So this particular indicator actually has 10 levels above R1 through R10 and 10 levels below S1 through S10 to accommodate all sorts of volatility on all different types of stocks and ETFs. This indicator also has an automated Fibonacci extension past R10 or past S10 should price happen to touch R10 or S10 within the same session. So in cases of that, which we'll show that in the new features video later this week, but in cases, say you're trading a microcap or a penny stock or a smaller cap stock that has an extreme parabolic move due to low float and being bounced around in day trading chat rooms and getting a lot of activity that day, a lot of those kind of stocks on that you will see throughout a given week can make parabolic moves on short squeezes, primarily short squeezes rather than collapses, but it's more prevalent in short squeezes, and so those stocks can move above the R10 level. So if that happens to happen, then we have an automated Fibonacci extension which will go up all the way to 17.944, and in that case that is something that can help you with parabolic moves that happen on those types of stocks if you're the type of trader that's inclined to trade stocks that are in the news, such as that are either penny stocks or small cap or micro cap stocks that have the potential for parabolic moves due to news or other manipulation that may be going on, and the fact that they may have a small float. Okay, so in this session, like I said, we have SPY, and we have the levels above R1. In this case, when you're trading something such as an SPY or a QQQ or an IWM or a mega cap stock such as Tesla, Nvidia, etc., then you generally just want to use the default levels of R1 through R6 and S1 through S6. So those are the default displayed main key levels above and below the bull bear KPL. The QL levels are used for tight stop losses. There's QL levels above and below each main key level. The ones that are turned on by default are the QL above the BBKPL and the QL below the BBKPL. And the rest of the QL levels can be turned on in the control panel should you decide that you want to take a bullish or bearish trade off of one of the other main key levels and you want to use a tight stop loss. The midpoint levels above and below each level are used for the standard stop losses on bullish and bearish trades from any main key level. The main key levels with this indicator are going to be the bull bear KPL, the R levels above, and the S levels below. We also have the contextual levels, the PMH, PML, YDH, YDL, and YDC, which you can also take trades off of with this indicator. However, for those trades, there is a special section in the user control panel for either selecting the standard stop loss or the tight stop loss for those bullish or bearish trades off of those levels. And then also, as far as the take profit, there is a take profit section as well, in which you would dial in your reward to risk factor that you would like to use, which is basically a multiplier of the stop loss that you chose to use, either the tight or the standard. The default setting on that is 2 to 1, so that's going to be $2 of target for every dollar of risk. That is adjustable in 0.25 increments below and above, and above 2 it will go all the way up to 30. Okay, so like I said, just a brief overview of these levels. We're not going to go into everything today regarding all the new features of this indicator and everything that we're going to release a video later this week when we actually release this to the public that will have go into greater detail on all the different features as well as other aspects of the indicator. Okay, so now we're just going to go into the trades for today's FOMC interest rate decision day. So on these types of days, the FOMC, you want to be fairly cautious on any trades that you take before the FOMC interest rate decision at 2 p.m. Eastern Time. And then also there is a conference at 2:30, which the Fed chairman starts at 2:30, the Fed chairman Jerome Powell. So that's typically when you'll start seeing acceleration or whipsaws in either direction once that conference call starts. However, there's usually typically a sharp move that happens typically in the majority of FOMC decision days, not every single one, but on most, that happen right after the 2 p.m. interest rate decision. Okay, so here we have trade number one, which is on the 9:30 a.m. opening candle. So as you can see here, we do have a pop-up alert for the 9:30 a.m. opening candle here on the BBKPL, and this is giving us a bearish signal. Now, this indicator has a acceptable filter built into it for alerts, and it also has a special alert that's only for the 9:30 a.m. opening candle of the session, and that is a singular alert for that particular candle. And with that, there is an acceptable range filter, which basically filters out trades or candle closes that would be outside the acceptable range for taking a 9:30 a.m. opening candle trade off the BBKPL. So for example, if this close of this candle was not where it was right here, but it was closer to this S1 level or was below the S1 level, then the alert would not show. The alert was only going to show if the candle close is either closing below within the acceptable range for a bearish trade off of this level, or if it was instead a close above, that instead you would see a green label that would be beneath the candle for a bullish close and bullish bias off of the 9:30 a.m. candle. And again, that label would only pop up if the candle close on the 9:30 a.m. candle was within the acceptable range for a bullish trade off the bull bear KPL. If it was outside the acceptable range, even though it was a close above, then the alert does not show. And what that basically means is that don't take a trade off the BBKPL because it is outside the acceptable range in either case, whether it's above or below. So if this does not fire, then there's no trade on the opening candle of 9:30 in either direction. Okay, so we've notated that here 9:30 a.m. opening candle closes below the bull bear KPL, and it's within the acceptable range, which is why we're seeing this alert pop up. So this is a bearish entry on the 9:30 a.m. candle close below the BBKPL. Now with this indicator, the 9:30 a.m. candle trade is an optional trade. You do not, it's not mandatory that you have to take this trade. However, if you look at our sessions normally that we have presented on this channel, that normally we're taking the 9:30 a.m. candle trade. However, that does not mean that it is mandatory. It is an optional trade. A lot of people prefer to just let the session play out, get the initial shakes out of the way, and then make a strategic move later on in the session, either after the opening range is played out, and people have different opening ranges that they follow. Some people just follow the old standard first hour opening range. Other people look at the first 30 minutes. Some other people look at the first 10 or 15 minutes. And there's a lot of people that look at the first 5-minute opening range. So it really just depends if you're more of an opening range trader, that whatever amount of opening range that you normally look at, then you can assess after that which particular level presents the best opportunity after that point that price action is showing a valid trade on. Now, if you've seen some of our other recent videos, we've shown that there are some additional free indicators on TradingView that can be used that are ribbon indicators. So if you look at one of our recent SPX videos in which we went over that, we're not going to go into that today again. But if you take a look at that video, I believe that was one within the last 2 weeks. That was the $4,100 gain session on SPX. That particular video, if you want to look for that thumbnail. And I believe there was one earlier this week that we also went over the ribbon indicator as well. So what that can be used for, one of those two ribbon indicators. One is called Annie's ribbon, and the other was the original Madrid ribbon. The ribbon indicators can also give you additional confirmation, or if the ribbon indicator is giving you a conflicting signal on a trade off of any main key level or one of these contextual levels, then you may want to consider just passing on the trade and waiting until both the ribbon indicator and the close above or below the key level that you're looking at on the trade line up and both confirm each other for either the bullish or bearish trade. Okay. So with this indicator, just like the SPX indicator, the Stocks ETFs indicator is always going to be, if you're going to trade options, And remember, with this indicator, this is a little different than SPX or the NDX. On SPX and NDX, there is no vehicle. You just can't trade the common or shares of it like you can with stocks or ETFs. So with stocks or ETFs, you can either trade shares if you don't want to trade options, if you have an account that's large enough. Or if you're trading options, then the same strategy that we show in the SPX videos would be the same in trading options here on using the stocks and ETFs, especially if you're trading a vehicle such as the SPY or the QQQ. And so with that, like you've seen in our other videos, there's going to be 3 different option strikes that you can utilize on any bullish or bearish trade off of any of the main key levels. And so how that is determined is basically the same process as we've shown in our SPX videos. So for example, this trade is a bearish trade off the bull bear key price level of 669.40. So the standard play as far as options on this bearish play off this level is going to be the option strike that is closest to the price of the level that you're basing the trade on. In this case, 669.40. Now SPY trades in 1-point increments. SPX trades in 5-point increments. SPY trades in 1-point increments. So you would have the 669 strike, and then you would have the 670 strike. And since 669.40 is below the halfway mark, then you defer to the closest strike. That would be the 669 strike. And in this case, that would be a put strike since this is a bearish play. So the standard play is going to be the 669 put option. We're on a 2-minute chart. We're buying on the candle close because we want confirmation of where this is closing for either a bullish or bearish trade. And so on the 9:30 a.m. candle close, the ask price $2.78. Now the 2 other option strikes you can consider on this bearish trade from the BBKPL level are done the same way as the SPX indicator. So if you look in the direction of the trade from the level that you're taking the trade from, in this case the bull bear KPL, you go to the first midpoint level in the direction of the trade below the level that you're trading. That's mid BBKPL S1, 668.27. The closest strike to that is the 668 put option. The furthest out of the money one you can consider on this particular bearish trade is going to be the strike closest to the level that is 1 full key level away from the level that you're taking the trade from. In this case, this is the S1 level here, 667.13. So the closest strike to that level is going to be the 667 put. So that would be your furthest out of the money. Now the first option strike here, the 668, the ask price for the 9:30 a.m. candle close, which of course is closing at 9:32 a.m. since we're on a 2-minute chart, is $2.33. And the furthest out of the money, 667, is $1.94. Now here we're trading in 10 lots. Why 10 lots? Because a 10 lot trade on this is pretty much equivalent to an SPX 1 lot trade. So SPX trades approximately at 10 times the value of SPY. So generally, one SPX option of at the money is going to be 10 times as expensive, approximately, as one at the money SPY option. So we're going to trade 10 lots, so that's equivalent to one SPX. And of course, you don't have to trade 10 lots, but trading 10 lots gives you the flexibility that if you want to scale out, if you're going to do something besides a scalp trade and you're going to do a regular trade, With this indicator, there's two different types of trades, as we explained in the other videos on SPX and NDX, and that is that you can either do a scalp trade with the daily key level strategy, or you can do a regular trade. And a scalp trade differs from a regular trade. In a scalp trade, you're looking for a quick in and out. There's no stop loss adjustment. You're not adjusting the trade. You're just simply looking for a minimum threshold, move in your favor, and then you're exiting 100% of your contracts. Whereas a regular trade, you can still exit 100% of your contracts at its minimum threshold move in your favor. However, depending on whether you're trading one contract or multiple contracts, you also have a scaling out option and then leaving remaining runners that are de-risked for additional moves. So for example, here I have a 10 lot on the 669 was 278, so each option is going to be $278. So on a 10 lot, 10 put options is going to cost us $2,780 plus any commissions and clearing fees, depending on the broker that you're trading with. That will vary. Some brokers don't charge commissions and some do. However, the clearing fees are generally the same, as those are pretty much fixed. Okay, so on the first out of the money strike, the 668, 233, that's going to be $233 per option. So 10 of those is going to cost $2,330. The furthest out of the money, the 667 was $1.94, so 10 of those is going to be $1,940. Now, the FOMC days, as we pointed out in our SPX video that we made on FOMC day recently as well, FOMC days, you want to be fairly cautious in the time period of the session that is prior to the 2 p.m. interest rate decision. So if you're going to be trading at all prior to that 2 p.m. decision, then you want to basically either do scalp trades or take regular trades and still exiting at the minimum threshold. And the reason for that is that generally on most sessions they pretty much are going to keep. Now this isn't 100%. We're just talking about most sessions. In most sessions, they try to keep price contained prior to that interest rate decision and the 2:30 conference call within a certain range. So you typically, even though there may be some increased volatility to begin with on an FOMC day, they're generally in most sessions not going to make an extreme run in either direction, unless of course there's some kind of news that just major news that just happens to also pop up on that particular day that's unexpected, that happens during the earlier part of the session, which every once in a while that will occur, but in most cases it does not. Okay, so here we have the 10:24 a.m. candle in which it hits S1. S1 is in confluence today with the pre-market low level, so it takes out both levels here in this one candle. And so we have a hit of the S1, and now we have our minimum scalp required move of one level in our favor. That's calculated the same way, just like we do with SPX. You're looking at the level you're taking the trade from. You're looking in the direction of the trade, which in this case is down, since this is a bearish trade. And we're looking one full level down, and that is going to be our scalp exit. So in a scalp only trade, from the BBKPL, the exit is the hit of the S1 level. It just happens that today the PML is in confluence with the S1 and it takes out both at the same candle. And so as mentioned earlier, a scalp only exit is 100% exit, no stop loss adjustment, no runners, no scaling out, It's just 100% out. So here are the bid prices on the 10:24 a.m. Close of the candle here. So generally, you want, with this indicator, what you want to do is either get out on the close of a candle consistently, or you can get out on the touch of a level consistently. It just varies from trader to trader. Some people find it a lot easier to just get out on a candle close, whereas other traders uh, prefer and find it easier for them just to get out on the touch of a level. Really, either way is fine. It just really, if you're going to do it, it's generally best to keep it consistent in whichever way that you decide is best for you. Okay, so here on the 10:24 a.m. candle close, we have the 669 put. The bid on the candle close $3.57. So on a 10 lot close, that's a profit of $790. On the 668 put, the bid is $297. That's a profit of $640 on a 10 lot close. 667, $244 in the bid. That is a profit of $500 on a 10 lot close. Now the candle right after this hits the mid S1, S2 level. That is now a 1.5 level move in your favor, and that is the minimum required threshold for a regular trade. Now normally, if this was not an FOMC day in the beginning part of the session, then you would have the option here on a regular trade to either adjust your stop loss, or on all of your contracts, or if you're trading multiple contracts, say 3 or more, or such as 10 with this 10 lot, then you would want to you would have the option to exit 60 to 90% of your options, and then adjust your stop loss to break even, or break even plus a small profit buffer on the remaining runners. And then what you're looking for is you're looking to manage those runners for a further move in your favor, and then either exit those at each continued level move in your favor. Then you have a decision at each of those level moves in your favor thereafter to either further adjust your stop loss on the remaining runners, leave it be at the original adjusted stop loss, or exit some of your remaining runners, or exit all of your remaining runners. If you don't exit all the remaining runners, then you would continue to manage the remaining runners as price continues to move in your favor down to additional key levels. And then you would have the same decision to make all over again. However, in the FOMC early part of the session, it's generally a good idea not to do that, because, like I said, generally to try to keep price contained in most sessions prior to the 2 p.m. decision and the 2:30 p.m. conference call. Okay, so the 10:26 a.m. we have the bid prices down here. So we have 669, $4.10 bid on the candle close of this candle here, 10:26 a.m. candle, and that is a profit of 1,320 on a 10 lot close. 668, 345 bid, profit 1,120 on a 10 lot close. 660, 285 bid on the candle close, profit $910 on a 10 lot close. Okay, now we'll look at the trade that occurred after the FOMC 2 p.m. decision in the next screen. Okay, now we'll look at trade number 2, which happens after the 2 p.m. FOMC interest rate decision, and that is going to be on the 2:04 p.m. candle. The FOMC interest rate decision at 2 p.m. Eastern. This candle here is the 2:04 p.m. candle. Here's the candle on the interest rate decision here. As you can see, wicked above S1, will close below it. Next candle also closes below S1 as well as PML. And then we have this third candle here, which again tried to wick above S1 could not close above S1, instead pushed back down below both PML and S1. So this is going to be the enter candle here, the 2:04 p.m. candle. You could have entered either here as well on this as being more of an aggressive move on this, considering it's an FOMC day. You're trying to look for a little bit more confirmation after an FOMC interest rate decision, due to the fact that sometimes you will get, or actually the majority of the time, you will get some whipsaw moves. So you're really just waiting to see more of a clear direction as you can for FOMC. Again, another thing you have to keep in mind is that a lot of people prefer not to even trade FOMC interest rate days, as they are elevated volatility, which means that the options are going to be a lot more expensive, and then you have the FOMC uh, padding on top of that, which makes them even more expensive than usual, um, because of the expected volatility on FOMC. And so, some traders just prefer to skip these days altogether. A lot of traders find that, the price action that typically occurs after the interest rate decision, and especially after the 2:30 p.m. conference call starts, to be attractive to them, as far as having typically, a wide range and whipsaw moves. Some traders prefer that type of environment. So it really just depends on your trading style, your tolerance for whipsaw moves, and whether these types of days make you a nervous wreck or not. So some people, like I said, prefer to trade these types of situations that occur after a major news event. Other people prefer to just skip them altogether. So it just really depends on the trader. The point it really is, if you are going to be trading, you're generally looking for uh, additional confirmation. You also have to be very wary of the whipsaw moves that can happen, so you have to be very wary of your stop losses as well. So taking profits on moves and adjusting your stop losses, and uh, keeping the remaining runners tight as well. Okay, so we have the 2:04 p.m. candle close, and it's closing below S1 and PML. However, the trade is off of the S1 level, even though the PML and S1 are in confluence. The S1, they are in confluence. However, the S1 is going to provide a better stop loss situation for this particular trade. So taking the trade off of the S1 level, your tight stop loss is going to be the QL above on this bearish trade. Your standard stop loss is going to be the first midpoint level above. So let me go back to the prior chart because I believe I did not reiterate the stop losses for that. So I just want to clarify those as well. So we'll stop here and go back to the previous chart. Okay, so back here on trade number one, the tight stop loss on this trade is the QL above the level we're taking the trade from, QL above BBKPL, and the standard stop loss was the first midpoint, a level above the level we're taking the bearish trade from, the BBKPL, so that's mid BBKPL R1 here. Works the same on any other trade off of any other main key level where you're using either the QL levels or the midpoint levels. So for example, if this instead was a bullish trade off the bull bear key price level, then our tight stop loss would be the QL below the level we're taking the trade from, the bullish trade from, or the standard stop loss would be the midpoint level below. If, for example, you were taking a bullish trade off of S2, then the first midpoint level below S2 is your stop loss on that bullish trade from S2, and you would go in the user control panel and turn on QL below S2 if you prefer to use the tight stop loss in a bullish trade from S2. Or if you're taking a bearish trade from R1, then the first midpoint above, mid R1, R2 is your standard stop loss. You would turn, if you prefer to use the tight stop loss, then the tight stop loss would be the QL above R1, which you would just simply turn on in the user control panel. Okay, so the option strike process works the same. We're just working off a different level since we're taking the trade off of S1. So we're looking for the standard play is the option strike price closest to the level we're taking the trade from, S1 667.13. So that's going to be the 667 strike. It's going to be a put since it is a bearish play. Here are the 2:04 p.m. data boxes here for the ask prices on the candle close. The first out of the money strike, same process as we did before. You're looking in the direction of the trade. You're looking to the first midpoint level in the direction of the trade. That since it's a bearish trade, you're looking below. So the first midpoint level below the level we're taking the trade from is mid S1, S2, 665.99. So that's going to be the 666 strike, and that's going to be a 666 put option. The furthest strike away for this bearish play off of S1 is going to be one full key level away from S1 in the direction of the trade. So that is going to be the S2 level 664.85. So that is going to be the 665 strike, which in this case again is a put since it's a bearish play. So on the candle close, we have a $1.64 ask. On the 2:04 p.m. candle close for 667. We have a $1.18 on the 666, and we have an ask of 82 on the 665. So on a 10 lot for the 667, that's going to be $1.64, so that's $164 per option. On the 10 lot, it's $1,640. On the OTM one strike, the 666, it was $1.18, so that's going to be $118 per option. So on a 10 lot, $1,180. The furthest out of the money, the OTM 2 strike, the 665 is 82 cents. So that's going to be $82 per option. So on a 10 lot, that is $820. Okay, so it works the same way. If you're just doing a scalp trade, you are looking for a one level move in your favor. One level move in your favor on this trade is S1 down to S2 on the bearish trade from S1. Here on the 2:38 p.m. candle, we have a hit of the S2 level. So that is your scalp only exit. So you're exiting 100% of your contracts on a scalp only. Here we have the 2:38 bid data boxes for that candle close on 2:38 p.m. candle. 667 put 267, profit 1,030 on a 10 lot close. 666 $1.97 bid, profit $7.90 on a 10 lot close. 665 $1.39, so that's a profit of $570 on a 10 lot close. Now, if you're doing a regular trade, then you're looking for the 1.5 level move in your favor for then having all the different options open to you as far as how you want to handle the trade on a regular trade. And here on the 3:38 p.m. candle, we do get a hit of the mid S2, S3 level. As you can see, the midpoint between S2 and S3, there's a lot greater distance than there is between the midpoint between the bull bear and S1 or the S1 and S2 level. So this is going to be a lot more profit here of this particular trade than would normally be on a 1.5 level move from either this bull bear key price level. 3:38 p.m. So we have the hit of that 1.5 level move in your favor. So S1 to S2 is one level down to mid S2, S3, 1.5 level move. Here's the 3:38 p.m. Data boxes here. 667 put, 442 bid, $2,780 profit on a 10 lot close. 666, 338 bid, profit 2,200 on a 10 lot close. 665, $2.45, profit 1,630 on a 10 lot close. Now, alternatively, the options are here on a regular trade to either adjust your stop loss to break even on all 10 contracts, or simply exiting all 10 contracts, as we already went over. The third option is to scale out and exit 60 to 90% of those 10 contracts, or how many multiple contracts you're trading. If you were trading 3, as an example, and you exited 2, that would be roughly 66%. If you're trading 5 and you closed out uh, 3 of them, that would be 60%. If you closed out 4 of them, it would be 80. So it really just depends on the amount of contracts you're trading. It's generally, with that type of scaling out strategy, you want to be trading 3 or more. So for example, on a 10 lot closing out 70%, we have the alternative here. Closing out 70% would instead be a profit on the 667 of 1,946 on a 7 lot close. 666, a profit of 1,540 on a 7 lot close. 665, a profit of 1,141 on a 7 lot close. Then you're adjusting your stop loss to break even, or break even plus a profit buffer of say 10 to 15% on that. However, you do have to keep in mind it is 3:38 p.m. It is FOMC on top of that. So if you are going to leave any remaining runners in the trade, if you are going to do anything, it's either I would not adjust my stop loss to break even and leave all 10. That would not be a good idea on considering there's only 20 minutes left in the normal session. One thing that differs from SPY options than SPX options that you need to be aware of is that SPY options still trade to 4:15 p.m. whereas SPX options stop trading at 4 p.m. There is no trading after 4 p.m. and then there's just a settlement. And with SPX options, you get a cash settlement of the difference if you're in the money. That the difference between your strike price and the closing settlement price of SPX, and then you would generally the next business day have that difference in your account if it's in profit. Whereas SPY options are not treated the same way as SPX options. So one of the differences is, and you can look this up yourself by either Googling the difference between SPX and SPY options, or you can ask ChatGPT or Claude AI. We're not going to go into that at this particular moment, but you can do that on your own and look at all the key differences between trading SPX versus SPY. However, SPY does trade through 4:15, so that's a little bit of a difference. So you would have that extra 15 minutes. So if you were inclined not to exit all 10 there at the 1.5 level hit, and you wanted to instead scale out 60 to 90% and leave the remaining runners to see if we have a further sell-off in your favor, then you would want to, again, you're either adjusting your stop loss to break even or break even plus a profit buffer of 10 to 15%. And then you need to be aware of the fact that you have to make some sort of decision before 4:15. It's advisable to start making that decision if you're waiting to the very end, at least starting a minute before that. So start lining up what your exit is going to be. If you're going to wait into that 4 to 4:15 period, it's generally better to start getting your closeout lined up at least a minute or two before 4:15 hits. So just keep that in mind if you are trading SPY. Okay, so one thing to clarify here, just for those that are not familiar with watching our other videos, is that When you have the initial trade, your initial trade is a level-based stop loss, such as we saw here in the initial trade number 1. However, when you're doing a regular trade and adjusting your stop loss to break even or break even plus a profit buffer, then you are instead changing your stop loss to a price-based stop loss, meaning the price of the option. So at that point, changing it to break even doesn't mean making your stop loss the level you took the trade on or the exact uh, price at which you on this candle close that you took the trade from. It instead means that you are changing it to the price you paid for the option if you're just going with break even, or the price you paid for the option plus a profit buffer if you're adding a profit buffer. All right, so we went over the differences here. If you just closed out all 10, what the profits are. If you're, say, closing out 70%, then it would be a 7-lot close starting with 10, and this is what the profit would be here that you're securing on that 7-lot close, and then you're waiting to see if your break even or break even plus your profit buffer stop loss is either going to get hit on those 3 remaining runners, or if it continues to move in your favor before that 415 cutoff, then you can decide to exit the 3 remaining, in this case, the 3 remaining runners for the whatever additional profit is still left on those. So here on the 4:12 p.m. candle, we have a hit of the S3. So remember, the 4:12 p.m. candle is closing at 4:14. So this would be the very last 2-minute candle here. And like I said, you would want to have your order starting to get lined up. While this candle starts at 4:12, you would start lining up your exit closeout. Okay, so here we're going to take a look at the difference between if you had held on to all 10 contracts versus the difference between just having the 3 left to exit, and then taking the combined profit of closing out 7 here combined with closing out the final 3 here. So here we have the 4:12 p.m. data boxes up here. We did get a further move down to the S3 level, 660.31. So the 667 is now 655 on the bid. The 666 is 555, and the 665 is 458. So on a 10 lot, then that would be 667 would be 4,910 profit on a 10 lot close. 666 is 4,370 on a 10 lot close. 665, 3,760 on a 10 lot close. However, scaling out 70% earlier, as we did, then you would have a 3-lot runner close. So a 3-lot runner close at the 655 is a profit of 1,473. 3-lot runner close on the 666, $1,311 on the 3-lot close. 665 profit 1,128 on a 3-lot runner close. So the total combined profit of the 7-lot close here and the 3-lot close is $3,419 profit on the 667s. The 666, $2,850 total profit on that, splitting the close between 70% here and the final 3 here. 665, $2,269 profit. So as you can see here, yes, if you'd held on, you would have had more profit, obviously, than doing it this way. However, this other way is the more prudent way of doing it over the long haul, because in this case, we're running out of time. And if you just did the adjustment to break even, very well, this could have moved back up and basically taken out all of your profits, and then you would have gone through all that just to get break even on all 10 lots. So you just have to keep that in mind. Sure, sometimes this is going to work out better. However, the more prudent thing to do as a system is to start scaling out. Now, if this was not an FOMC day and this was all occurring earlier in the session, then you could instead wait for the 2-level ideal minimum move to make all these adjustments and start scaling out rather than the 1.5 level move. That's up to trader's choice as to whether you want to do it on the 1.5 level minimum required threshold or wait for the 2-level ideal. 2-level ideal that mirrors the SPX. Since we're trading SPY, it's going to have the normal range of SPX as well, which as we've gone over in our SPX videos, the 2-level is the minimum ideal move on a regular trade, whereas the 1.5 level move is going to be the minimum on a regular trade. So you just have to keep that in mind that with the stocks ETFs indicator, if you're trading SPY, that's one thing. If you're trading just, some mid cap or small cap, micro cap penny stock, those minimum thresholds are not going to generally apply the same on those particular stocks. And that's why we have a historical sessions feature in this indicator, which we're not going to go into today. You can either look at the features video for the SPX v3.0, in which we go over the historical sessions feature, or you can watch the video later this week for the stocks ETFs. It's basically going to be the same process and same historical session features that we will outline in that video as well, but through historical session study and analysis, which becomes even more important with stocks and ETFs because there's so many different ones for your particular stocks and ETFs that you like to trade. It is very important to look at historical analysis of sessions, both for the market scenarios that occur in the historical sessions, as well as getting an idea of the general key levels average daily range for the particular stock or ETFs that you are typically trading. Okay, so that's going to wrap it up for today's video. If you enjoyed this video, I'd appreciate it if you would hit the like button, as that helps us with the YouTube algorithm. If you'd like to see other videos when we post them, whether it's on the SPX indicator, NASDAQ NDX indicator, we are going to start posting a lot more videos on stocks and ETFs using the new V3.0 stocks and ETFs indicator after it is released later this week. So you'll be seeing a lot more videos on stocks and ETFs utilizing this indicator in the future. So if you'd like to be notified of those videos or any other videos that we put out on trading in general, then please hit the subscribe button. If you are interested in purchasing this indicator, then you can send us an email at daytradinggps@gmail.com to request a discount promo code for purchasing lifetime access to this indicator. If you're also interested in any of our other daily key levels indicators, you can also request a discount promo code for any of those. We also have, of course, the SPX daily key levels V3.0 indicator, the NASDAQ NDX V3.0 daily key levels indicator. And then after the stocks ETFs V3.0 is released later this week, in the next few weeks after that, we'll be releasing the futures V3.0 daily key levels indicator, followed next by the Forex cryptocurrencies V3.0 daily key levels indicator that will have all of the V3.0 features as well. Okay, so thank you again for taking the time to watch this video today, and we wish you much prosperity in all of your future trading.